We're back now with economic news. Stock markets closed lower on Thursday after September inflation came in slightly higher than expected. Inflation rose by 0.2% month over month and 2.4% year over year. And in a separate report, jobless claims also came in higher than expected for last week. The data comes nearly a month after the Federal Reserve slashed interest rates by 0.5 percentage point, the first cut in 4 years. Joining us now, editor-in-chief at Investopedia, Caleb Silver. Caleb, good to have you with us. So it looks like investors were a little disappointed by this latest round of economic data. Why is that? Should we be worried?
We should not be worried. The stock market is at or really close to record highs right now, and inflation data is going to be lumpy just because prices are lumpy, especially when you have supply chain disruptions. And we've had them in the form of hurricanes. We've had them in the form of a potential port strike. So you get lumpy numbers there. And the rise in inflation was mostly due to shelter and insurance, two things we can't get away from, but two things that are tightly controlled by supply and demand. So I wouldn't get too excited about that. The fact that investors may have sold off yesterday, there's plenty of reasons to sell, but they've been sitting on some massive gains so far this year, and the trend is usually more higher highs after higher highs.
So, Caleb, as far as the Federal Reserve is concerned, does this data change any expectations for more interest rate cuts in November and then beyond?
Yeah, we have that Fed meeting right after the election, November 7th, and the overwhelming thought is that the Fed will cut rates again, maybe a quarter point, but there is one more meeting before the end of the year in December. They may cut then as well. They're not going to look at the data out from yesterday or the producer price index, which is coming out at 8:30 this morning, and say, maybe we should or maybe we shouldn't. They're going to look at the impact of those half-a point cuts that they made at the last meeting and see if that really slowed down the labor market. You bring up weekly jobless claims. Well, weekly jobless claims also impacted by the fact that we've had a couple of hurricanes right now. We had a potential strike. We have the machinist strike at Boeing. That causes furloughs in other places. You want to look at the moving trend here. If that number starts to get higher week after week, that could be a warning sign that the Fed may have to do something a little bit more extreme. But right now, this is the soft landing that the Fed was hoping for, and it's going to be a little lumpy, especially with inflation, because prices do go up and down. They're just not coming down very fast.
You mentioned the jobless claims. You mentioned Helene. So the question now is, after Hurricane Milton, could that have an impact on some of the job data we see moving forward?
For sure. And that doesn't mean people are going to get laid off, but folks that are connected to the workforce, whether they're contractors, whether they work for companies that had to shut down because of the hurricane, and maybe they're on temporary layoff, they may report unemployment claims, and that could drive that number higher. So we've had a lot of supply chain impacts. We've had a lot of impacts just to the way we do business in this country because of these storms, and obviously because of the potential strikes. That's going to impact those weekly numbers, but you want to watch the trend. And the trend we saw last month, Joe, was that unemployment fell from 4.2% to 4.1%. We're really close to full employment right now. The economy is growing, and so that's a good sign. It just, these things are unpredictable, and when we have hurricanes, you just don't know what's going to happen to the weekly numbers.
So just big picture, what does all this mean for everyday Americans who are managing their bills and their finances?
Don't expect prices to come tumbling down the mountain. We have seen retailers start to cut prices as consumers have become more sensitive, but don't expect inflation to turn into deflation all of a sudden, and you don't want that anyway. So expect prices to remain somewhat stable here around 2.5%. But the good news is, as rates come down, you're going to have, it's going to be cheaper to borrow money. Your credit card APRs are going to come down. Mortgage rates are going to come down. You just might earn less in the bank. But this is kind of where the economy is going to be through the rest of the year and even into next year. It doesn't matter who's president.
All right, Caleb Silver, have a good weekend, my friend.
Thanks for watching. Stay updated about breaking news and top stories on the NBC News app or follow us on social media.